Over the last week, we've seen a lot of news come out about markets, including geopolitical conflicts, NVIDIA's big earnings announcement, and of course, now what's going on in bonds. But could it be that we're just seeing the start of potentially even further big volatility spikes in 2026? Today, we take a look at what's really moving these markets, and more importantly, some of the key things that we all need to be paying attention to as traders and investors. Welcome to Pepperstone's Macro Edge. Well, welcome back everybody to Pepperstone's Macro Edge. My name's Thomas Atkinson, and today we're taking a look at everything that you need to know right now about the flows in the markets, including what's happening in the energy sector, and of course, whether NVIDIA, the biggest stock in the world, can currently hold the sell-off that started after a pretty good earnings result. But to kick things off, I think we need to talk about the current debt issues and, more importantly, what the bonds market is telling us. This chart here, shared from Barchart at Barchart over on X, sourced from Bloomberg and Sherwood, does show a big problem, and that problem has to do with 5-year credit default swaps. Basically, we're seeing an expanding risk here of the overall swaps, and this is telling us that the once gold standard of, let's say, big software bonds are not so anymore. And of course, it's one reason, and that is AI expenditure. The markets, particularly the debt markets, are concerned about whether AI data centers are actually going to create enough growth to really justify the spend. And this is the beginning of what you always see in every new technology, which is, will the hardware build out end up bringing, I guess, the fruits of the labor? Sometimes you see it does, sometimes it doesn't. And while I think we can all probably agree that in general AI is probably the future, there are sometimes issues with the markets. The markets do want to see instantaneous gratification, and that's going to come up more and more this year in 2026 as we see each earnings result, especially in Q1, Q2 earnings of this year. So let's talk about debt in defaults. Now, it's not just in the credit default swaps for what we're seeing in the big tech companies, which is widening. We're also seeing some problems here when it comes to household debt. And according to Barchart at Barchart again, and the Bloomberg and Federal Reserve Bank of New York, we are now sitting at 4.8% of all household debt is now in the delinquency stage. And this is something that's starting to expand and starting to get a little bit worrying. Now, we've seen something similar to this happen in 2006-07 before the global financial crisis. We've also seen something like this happen back in that kind of 2017 period into 2019. Now, why is it important? Well, basically, it's all about this 30-day trend rate, and you can see that starting to expand a little bit off the data that we have. So why should we be paying attention to this? Well, it has to do with the sectors and the way that the market is currently rotating. This one here from @BlueKurtic over on X shows the sectors of this year and what's been doing well and what hasn't. And we do have a little bit of a different story from 2025. In 2025, it was all about tech stocks. It was all about pretty much communication, industrials. In 2026, it's all about energy, materials, staples, utilities. And a lot of these are considered what we call defensive on the market. You'll notice actually year to date, financials are only not even up. They're down 6.1%. And even the hardware section, often considered the best section, is starting to slow a little bit, which is, of course, semiconductors. So we have to be paying a lot of attention, particularly to NVIDIA, after what was a great earnings result, but still didn't provide, again, a boost to send us to new highs. What about cap versus equal weight? This is a great chart here from @Duality Research over on X. And what it really shows us here is that we're starting to see a bit of a divergence between the energy markets and their average return, the tech markets, which is, of course, the back end of really hardware tech, so that's semiconductors, and software, which is coming under fire because everybody's looking over here at hardware tech. So this is a tale of two different stories, and you can kind of see it in the flows. What we've had all of this year has been breakouts in breadth, breakouts in different markets, which we'll look at in the charts in a minute, and we haven't actually seen, let's say, the normal crowd, the technology, the software, that kind of thing, other than the hardware side, really boost up. So this is why it becomes NVIDIA when we're looking at the charts moving forward. Another big question here is whether we can get through 7,000 at any point soon. Now, everybody knows that these are huge landmark points. As you can see here from BlueKurtic, he's gone through and he's looked at every 1,000-point increment for the S&P, and it's amazing when you look at which one and when it was reached. 1,000 was actually reached in 1998 before the dot-com boom, and then of course we see here the 2000 level actually took till 2014, 19, 21, 24. Wow, we're actually just hitting each 1,000-point increment faster and faster and faster as we accelerate into this decade. So what about 7,000? Well, it's been a little bit of a different story. We've hit it once, we've hit it twice, we've hit it almost 3 times, and we've sold off each time. And this has created what we call a pit or a channeling style market. And it means that there's a lot of transactions going in underneath the hood, as we'll see with the advanced decline line, but it's not really an index market unless you're range-bound trading. It's more of a stock selection or sector-based trade. We've seen some large trades come in as well, marking those points. Volume leaders here showing that oil has had some of the largest transactions we've ever seen on it, and this is of course in the wake of all the geopolitical tensions that have been going on recently. And it does mean that all eyes are on oil. So let's now take a look at the charts and see what really has been happening underneath the hood. And first up, we have to start here with, of course, the S&P 500. And you guys can see that one of the big things that's happened is the advanced decline line, which is a great one to have on the charts with the S&P, showing that stocks are actually underneath the hood going up, has continued to increase. And generally when this is happening, it's just showing a broadening pattern, and it's not necessarily a sign for concern. What we do have though is price stuck within this tight range. So effectively we have a market that is both tight and also rotating underneath the hood. And one of the reasons it's possible for us to see more stocks advancing than declining yet still be trapped is concentration. Big technology stocks like NVDA haven't exactly been performing very well recently. Software's been down, and that made up over 37% of the market. So concentration has kept us within. For now, the key levels to watch on the S&P major close are between 6,770 to 6,800, and of course that magical 7,000 level, which we've hit several times and been unable to break through. When we take a look at the Pepperstone's futures, you can see here that there has been some reaction off that 6770 zone over the last day of trade. And one of the reasons is, of course, we've seen all this geopolitical conflict that creates a lot of fear in markets. But really, again, we have to look at the flows. And in this case, the flows have not broken to the downside just yet. They're still trapped in that very tight range. So it's a very important level for all of us to look at as traders and investors. Let's have a look at some of the lead indicators here. One of those has been oil. We can see here that Brent crude actually spiked up and hit one of the major resistance levels straight after everything that happened on the weekend. And the actual market itself was already in an increasing kind of trend line. So you can see here that we had a series of higher highs and higher lows coming into everything that's gone on. And then the market instantaneously hits what we call the next level of equilibrium. So basically the next level of major resistance or support. And that's why at the moment, at the time of this recording, we're finding the market kind of sitting sideways, even though things seem to be still kind of going on around the world. And obviously we'll see how that one plays out. In terms of semiconductors have fallen a little bit since NVDA earnings. Now this is still in a market uptrend. So you can see here still a very, very bullish market overall, and something to continue to watch. And we've drawn a small trend line behind the back as things like the 50 daily moving average, which is this blue squiggly moving average here, will be levels to watch, along with NVIDIA, which is going to be, very key here at the 170 marker. Now we got down close to that price. You can see volume has gone up. The earnings was pretty good last week, yet the market said, you know what, we're going to sell off. And this is a classic case of if it's in the press, it's probably in the price. Everyone was looking at NVIDIA, yet it had a great earnings, beat expectations, and still sold off. And that's why we often say, look at the technical analysis, look at the flows, and pair it together with the data, the macro, and everything else. Key level to watch, 170 moving forward on the support side, and 200 on the call side. So actually a trap market, but again, NVIDIA not actually breaking down at this point. Now, in light of everything that's going on, we also see a bit of money moving towards the hedges of the world. And one of those hedges is often considered the US dollar. And you guys can see here that we've got this lower high kind of thought process. The markets have, of course, been going down, and they have not breached through this trend line just yet. But it's the first sign of strength in the dollar that we've seen in quite some time. So if we go back to the weekly, we can see that on the macro side of things, we're on that huge trend line that comes all the way from back in the global financial crisis. And we've found some bid buyers so far, but the trend still is down with a series of lower lows and lower highs. So first levels to watch, things like 99.30 and 100.25, which could be potential breakout highs. So it's a very interesting chart. And remember, if this does end up going bullish, then that could actually change the way that people look at the US dollar this year, which most people have been looking at it bearishly, as the debasement trade has been one of the most popular. So what else is really moving the markets at this stage? Well, of course, we've also had some pretty big movements in the Russell 2000 and small caps. Emerging markets have seen a lot of inflows in recent weeks, and we have a lot of range-bound markets in things such as the NASDAQ and S&P. It's clearly shown here that basically we're seeing a huge movement into other sectors and other areas of the world, and this happens often during a later cycle in markets. We're also seeing some life in Bitcoin and Ethereum once again from what's happened over the weekend, and that has created a spike off the 62,000 zone all the way back up into the 70K to 72,000. So this area here will be something that we continue to watch as we go through the next week, with 72,000 being often considered by many to be a potential bull kind of signal that markets actually could be finding some support. There's a lot of potential. There's obviously a lot of uncertainty in markets as well at this stage. So the key thing to look at is always going to be the flows and, of course, bring it all together. Remember, guys, to practice risk management whenever necessary with everything that you're doing, and, of course, to expect the unexpected. We hope you enjoyed Pepperstone's Macro Edge, and if you're interested in following, check out the description down below, and also, of course, press subscribe and hit that bell. Thank you so much. We'll see you in 2 weeks. Bye for now.